Well, welcome back to Finance Uncut. On today's episode, investors dumping Bitcoin and rolling into gold and silver. In this video, we're going to have a look at some really important macro charts. We're going to look at some charts on the stock market, see where that's headed. We're going to have a look at what's happened recently with Bitcoin, gold, and silver, so that we can have all the information so we know where things are going, so that we can be prepared and allocate our portfolio for the macro environment that we're headed into, in my opinion. But before we get to that, let's cut to a clip with Economist Nouriel Roubini, who talks about stagflation and a market crash.
Okay, so we have this unprecedented stimulus, helicopter money, record low rates, and the Fed is saying that inflation will be transitory and claims that it can be controlled. So how does this play out?
Well, my concern is that while in the short run, inflationary pressures are still limited, the rise in inflation we're going to see this year is not going to be just transitory and driven by a base effect, but it could be more persistent over time. Why? After this COVID crisis, we had a massive amount of monetary and fiscal stimulus and credit easing, $3 trillion of stimulus last year, 900 last December, 1.9 trillion just passed, and now 4 trillion plus of various types of infrastructure spending that may be passed by Congress. This is a time where the economy is already starting to grow faster and improving than previously expected. So it looks like the stimulus, one, is excessive. Two, there are supply bottlenecks. We're seeing semiconductor, pharma products, commodities, and so on. So we are now surging demand because there was a buildup of savings built also by the transfers of the government. There's pent-up demand, and there is now constraints on supply. And that implies that inflation over time may go much higher than the Fed expects. The other concern I have is that not in the short run, but over time, we can go back to not only inflation, but also to stagflation. What is stagflation? Is a situation of low economic growth, if not negative, and rising inflation. Now, last time we have seen it was in the 1970s, when we had two negative supply shocks, the Yom Kippur War between Israel and Arab states with a spike in oil prices, and then the Iranian Revolution with another oil embargo. This time around, most likely, unless there was a war between US and Iran, the negative supply shock is not going to be driven by oil, but there are other factors that suggest that there could be reduction in potential growth and a rise in cost of production that are negative supply shocks. And if you monetize fiscal deficits in that context, you may end up with inflation and stagflation. Now, what are they? We have now deglobalization, fragmentation of the global economy, balkanization of global supply chain, reshoring of foreign direct investment from China to high-cost regions like US and Europe. We have import protection. We have restriction to trade in goods, in services, in labor, in capital, restriction to migration. We have this decoupling between US and China on trade, technology, data, information. We have now also a declining in the supply of labor because US, Europe, Japan, advanced economies are aging, but not only advanced economies are aging, but now China, Russia, Korea, and other Asian countries are also aging. And you add to it also now policies that are going to be progressive to try to redistribute income from capital to labor, because labor has been disadvantaged for the last few decades. And that can lead to a buildup of wage and price pressures and are reducing potential growth, increasing the cost of production. Then you monetize large fiscal deficits, and down the line, I'm not speaking about this year, but 2-3 years down the line, we could also end up into stagflation, recession, and inflation.
You still think that the Fed is functioning as an independent, apolitical body at this point?
Well, my view is that the Fed is becoming less independent because there is so much debt in the system that if the Fed were to try to do the right thing and raise rates when we reach full employment, there'll be a financial market crash. And I'll give you just one example. In the fourth quarter of 2018, this was well before COVID, the Fed was saying I'm going to keep on doing quantitative tightening, reduce the balance sheet. I'm going to keep on raising policy rates from 2.5 to 3.5. What happened? Credit market shut down. Credit spreads went through the roof. The stock market fell 20%. And then January 2nd of 2019, Powell says, I was kidding when I said we're going to reduce the balance sheet. I was kidding when I said we're going to raise rate. We're going to stop. And not only they stopped, but once you started having problem in the repo market, and once the economy slowed down in 2019, they started to cut rate, and they started to rebuild the balance sheet. And this was well before the COVID crisis. It was a year before. And of course, once the COVID crisis came, they went to zero, forward guidance, quantitative easing, credit easing, backstopping bank, non-banks, commercial paper, even the corporate debt market, and so on. The point is that there is so much debt in the system that now we're in what the economists call fiscal or debt dominance. That meaning the central banks cannot be independent anymore, because trying to raise rates in a world where there is so much debt is going to crash the debt markets, the credit market, the stock market, and the economy. And therefore, the Fed is trapped in having to keep on monetizing these large deficits and debts on a permanent basis. And that eventually leads to inflation.
So Bitcoin price tumbles while investors are pulling out and putting their currency into gold. And JP Morgan says that big institutional investors are now dumping Bitcoin and going back into gold. Now, when we have a look at the Bitcoin chart over the last month, you can see that it's not performed very well at all. And it's actually more correlated with the stock market or risk assets. So people call Bitcoin digital gold. For me, I agree with people like Peter Schiff that it's nothing like gold. You can see this is the NASDAQ chart, so it's a lot more similar to the NASDAQ chart, because over the last month, here you can see another chart, Bitcoin versus the S&P 500. And you can see that it's more correlated with other risk assets, because silver and gold over the last month have been doing the opposite. So while stocks have been falling, while Bitcoin and other cryptocurrencies have been falling, silver and gold have been doing very, very well. And this is I get some complaints, that gold and silver isn't skyrocketing to the moon yet. Yet it has performed extremely well. Even if you go back and look at a 3-month chart, the last 3 months, have a look at how gold and silver has been performing compared to other risk assets. Gold and silver are doing their job plus some. So be patient. Gold and silver, it's not going to go up in a straight line, and it doesn't go up overnight. It's not like Bitcoin and other cryptocurrencies. It's not. And that's why I am invested in gold and silver. So looking at some macro charts. So this comes from Lynn Alden. Guys, I'll put a link in the description below. Sign up to her free newsletter. You will love all of her info. You're missing out if you don't get it. So look, a lot of the argument around the inflation-deflation debate is inflation or currency is created by the banking system, the private banking system. And in general, yes, they are right. But there have been times before where governments, through their deficits and basically having central banks monetize that, even if the dealer banks are the middleman, it's a quasi form of monetization. You do get broad currency growth. And this chart, if you go back to the 1910s, you can see huge government deficits. Loan growth was flat at best. Yes, it fell into the 2021 depression. But you can see that the broad currency growth spiked up with those government deficits. But even more important is in the 1940s, you can see that loan growth actually fell in the 1940s. Government deficits went through the roof, and we had broad currency growth through the roof as well. and look at it in more recent time. What's going on? Yeah, sure, loan growth is low, but governments all around the world are deficit spending. A lot of it, most of it, is being financed by central banks, and that growth of central banks buying these government bonds has been growing over the last 12 to 18 months. So what happened in the 1910s and 1940s? Well, they were very inflationary environments. So here's a chart from the 1940s and 1950s. It's funny, the 1940s very similar to now. So you had CPI. You can see the CPI spikes while interest rates were held down, and that's where we are right now. And then you can see the 1970s. Well, CPI rose, interest rates rose to try to combat that CPI. But the question is, will the central banks do that? Yeah, interesting. What is interesting to note is in the 1940s here, so you can see some of the spikes of CPI back then were 20%. But anyone holding physical cash or cash in a bank or T-bills or T-bonds lost between 30 and 50% of their purchasing power between 1941 and 1951. So think of that for a second. Between 1941 and 1951, if you held cash in a bank, T-bills or T-bonds, you lost between 30 and 50% of your purchasing power. So here's those inflationary spikes that you can see in the 1940 period. And you can see the CPI numbers down below. So what's interesting is after each inflationary spike, prices remained at their permanently high plateau. Okay, so in other words, inflation was transitory in rate of change terms, but not in absolute terms. And the graph below shows that. So, yeah, consumer prices increased 90% between 1940 and 1952 to a permanently higher plateau. This is what people don't understand. They're not thinking. They're listening to central banks. They're listening to media talking about transitory. And yeah, it might be transitory in the rate of change. Okay, so inflation, or you get CPI going up 10%, 20%, whatever. And then it will drop back to 2% and then straight up to 6%. However, in absolute terms, no, it always moves to a permanently higher plateau. This was an interesting chart that came out. The Bank of America did their global fund manager survey, and 77% of fund managers believe that we're moving into an inflationary type period in the next 12 months. So either above trend growth and above trend inflation, or below trend growth and above trend inflation. So either that stagflation or inflation environment. Either way, it's going to be painful. That's 77% of global fund managers. And the harmonized index of consumer prices, 4.9%. 4.9% from the April numbers that came out, 4.9%. And, you know, the prices aren't just rising in the US. Canada has experienced the fastest rise in consumer prices in a decade. Their annual inflation numbers came out in April at 3.4%, which was 2.2% in March. So we're just waiting for our numbers to come out in Australia, and you know, it should be no different to what we're seeing in Canada and the US, and that's at these CPI numbers, and we know that the CPI is not recorded the same way that it used to back in the 70s and 80s. CPI has been changed to really measure it a lot lower than it really is. So you're not comparing apples with apples if you want to compare any CPI numbers with the 1970s. That's what I'm saying. So what's interesting, Jesse Felder, by the way, sign up to Jesse Felder's stuff as well. Once again, you just get so much great information. But inflation's magic number is 4. So since the S&P 500 was created in 1957, US inflation has risen above 4% 9 times, and in 8 of those cases, stocks were lower 3 months later. The exception was in 2005 when inflation fell back below 4%, again, almost immediately calming investors. So keep an eye out. This might be something to keep an eye on. So if inflation rises above 4% and holds, if history is anything to go by, then the stock market will be lower in 3 months' time. Now we know what stocks, and I've shared this chart in other videos, what stocks are like during inflationary periods. So if you look at that 1910 period, stocks performed hopelessly. The 1970s period, but even in this chart, that 1940s period, if you have a look, it was choppy, but really it went nowhere. If you bought the stock market in the late 30s, it wasn't until about 1951, 52 where you started to make a profit. So for a decade, you went nowhere. So what's interesting with this, so the price there in January 1991, what's interesting about that, so when we look at this inflation adjusted price of the market, the Dow, it took 62 years. So if you bought the stock market in 1929, it took 62 years with a 0% inflation adjusted capital gain to get to basically break even. So 62 years on an inflation adjusted basis to break even. Now, yes, it did break even earlier than that. However, we know during the 70s, the market fell on an inflation adjusted basis. So it wasn't until 1991 where it sustained from that 1929 high. This is just a warning about where we are today with the stock market being severely overvalued on every metric. And if we're moving into an inflationary environment, what does that mean? If we're buying the stock market, especially these growth stocks, these stocks that don't have much revenue or profit, and they're trading on multiples of 40, 50, 60, 70, 100 times earnings, what are the gains going to be in the years and decades ahead? I think the returns are going to be very poor for people buying in right now. But don't take that as advice. You do whatever you think is best. If you think the stock market's going to continue to roar into outer space, and go ahead. So I love this chart. So we can see that margin debt has played a big part in the growth of the stock market. Debt in general, whether it's corporations getting funds and issuing debt and then buying back their own stock, or retail investors and larger investors using margin debt to do that. But it also correlates with bond yields falling and commodity prices falling. Now, if bond yields and commodities turn around, and in recent times you can see that they have, what does that mean for asset prices, in particular the stock market? Obviously, I believe that we're headed into a commodity super cycle, and even at these prices, I think commodities are still going much, much higher from here, even though they may pull back, go sideways a little bit for a little while. Bond yields, they want to rise. The free market wants them to rise. It'd be interesting to see what central banks do. Do they come in and do yield curve control, which is basically creating new currency units to buy more and more government bonds? If inflation or CPI is rising to substantial levels, then no private individual or any type of investor will want to buy a government bond, a 30-year bond at 2 point something percent if CPI is at 5, 6, 7%. So who's going to buy it? The only organization going to buy it is central banks. So central banks create these currency units to buy more government bonds to try to keep the yields down. And what do? They just make the whole inflation situation even worse. So we'll see which way they go. But either way, when the stock market starts to fall, margin debt, when these margin calls come into play, people start liquidating things to try to cover their margin debt. Sometimes they can't, so they just sell, which it's a cycle that just repeats on itself, and we could see an almighty fall in the stock market and other assets. I don't know, maybe similar to what we've seen with Bitcoin recently, maybe even worse than that. One thing that I do think is starting to look good is value. So when we look at this chart, comparing value stocks and growth stocks, when value bottomed in February 2000, value went on to beat growth by 14.3% annually for the next 7 years. And I'm certainly invested in the stock market. I've got stocks. I've shared previously, gold and silver miners, explorers, other commodities, biotech, and value. So I haven't shared this before, but I bought coal companies that are trading at 1.9 times earnings, 2.8 times earnings, 3.4 times earnings, 4.8 times earnings. Really, really cheap, paying 10 to 20% in dividends. There's reasons for that, but value looks like it's starting to turn. What do you guys think? Do you think that's going to play out again? I just like buying things that are undervalued, that are cheap. Over the long term, it does well for me. What is performing really well are my gold miners and explorers. So when we look at the GDX versus gold prices, the miners are outperforming the underlying metal. And we know the underlying metal has been performing quite well recently. I've shared this chart in previous videos where it hadn't broken through that yellow line, and now it is. And so gold miners, I love it. Gold miners, and I've got some gold miners that I sell covered calls on. And I'll talk more about covered calls in another future video. I've talked about it in previous videos, but in a video coming up shortly, I will talk more about that again. I just love selling covered calls and writing naked puts. Love it. So those of you who are fans of The Wolf of Wall Street will know this scene. You can replace gold for silver in this as well. Anyway, guys, that's it for me. Love to see your thoughts and opinions in the comments below. Don't forget to hit that like button. Really appreciate that. Anyway, take care, and I'll see you again on another episode of Finance Uncut.